Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. All right, welcome to We Build Great Apartment Communities. So another show, excited to have our guest today, Chris Salerno, someone that I feel you're going to find very interesting, kind of a unique background. He is from the Carolinas, in this case, Charlotte, Carolina.
Oh, yeah.
Charlotte, North Carolina. So, Chris, welcome to the show.
Thank you so much for having me. Very excited to be on here.
Awesome. We're excited to have you. So I'm gonna start engaging our audience right now with your background so that they get a better feel for who you are, your experiences, and then we're gonna dive in. So, Chris, kind of a unique background. So, excuse me. Chris is on the board of directors for $1 billion real estate.
Not anymore. I'm sorry, I didn't update that. Not anymore.
Okay, good. Well, I appreciate you sharing that.
Yeah.
But now that you're you relocated to, in this case, Charlotte, North Carolina, right? You developed an extreme passion for real estate, and by the time you're 24, you were principal of your company, Chris, and you successfully transacted more than $40 million in real estate volume. And you helped lead the #1 real estate team in Charlotte to produce more than $140 million in annual sales.
Yeah.
So named Charlotte's 30 under 30, Elite 50 entrepreneurs, 30 under 30 entrepreneurs, and nominated for Forbes 30 under 30. You know, you've quickly gained some great recognition, Chris, and some notoriety based on your hard work and dedication. So, hey, I appreciate the bio. And now we're going to take all of those great accolades, and we're actually going to format that in this show to where our audience can gain some value out of all those experiences, all right?
Yeah.
So, hey, but tell us a little bit about why Charlotte, North Carolina.
Yeah, so I've been here over 13 years. A while back, family moved here and moved with them, and I loved it. Loved it ever since, originally from South Florida, but Charlotte's phenomenal. It sits in the middle of the East Coast, so I'm 2 hours from Manhattan, 2 hours from Florida, and it's just a great place to be.
Yeah, that's what I hear. So why multifamily real estate? You know, what's the story behind that has allowed you to transition into, or why did you transition to multifamily real estate?
Yeah, it's economies of scale, really. When it comes to it, you can have one roof and 50 people under it, and that's one reason why I loved it. Another reason is I studied the '08 crash and realized that it was the strongest asset class and it recovered the fastest, and that definitely sparked my interest. And it's a necessity. We need shelter, we need housing, so I love it.
So where in Charlotte are you currently, invested in? Are you predominantly in that market? Are there sub-markets that you're in right now there? Are you in different states?
Yeah, great question. So we focus very heavily on the major cities in the Carolinas: Raleigh, Charlotte, Greenville, South Carolina, and Charleston, South Carolina, and their MSAs. And the good thing about Charlotte is that you're in the middle of both of the states. So it's only about a 3-hour drive to wherever you want to go. So it's very helpful.
And, I know North Carolina, there's a lot of buzz around North Carolina, of course, the submarkets that you mentioned, or the markets that you mentioned. Why? Can you share with our audience, why just maybe the demographics and some of the trends there, or just so that they can have a pretty good feel for why your focus is in those markets and maybe some of the excitement, the buzz that's going on there?
Yeah, great question. The main focus, and I think a lot of companies are realizing this, is one, the mayors and the mayors are giving huge benefits to these companies that are coming here. But companies are realizing, one, the tax rates here, and then also on top of that, the low cost of living, because the Carolinas does have a very low cost of living, and the seasons. We really don't experience hurricanes or anything, any really natural disasters, and that's another reason why a lot of people are flocking here. We have a large airport, which a lot of companies like because we do sit in the middle of the East Coast. We're only 2-hour plane ride to New York or Miami, and it's very helpful when you're flying your executives or when you're flying employees to go to any type of meetings. So I think that's very helpful, and that brings and draws a lot of employment to the city of Charlotte and to the Carolinas in general.
Sure. Well, I really appreciate you sharing that. I am going to, now that we've given our audience a background, your background, why the markets that you're in and why you like those markets, I'm going to dive into some questions.
Yeah.
So, we're in a very unique market right now, COVID-19.
Oh, yeah.
And so, of course, things have changed quite a bit as a result of that. What trends do you see taking shape or forming as a result of COVID-19? And, how are you guys preparing to position yourself for those opportunities?
Yeah, communication is key when it comes to COVID-19. Is staying in communication with your property managers and them staying in communication with the tenants. On top of that, I think the biggest factor is if the government's going to extend the eviction laws, that's going to be a huge factor on whether or not those eviction laws get extended, and if the stimulus check's going to get extended. I know they were supposed to do something this week, but I haven't got a notification or heard anything that it was final. And as of today, starting tomorrow being the first, it's gone. So that's going to play a big factor into what's going to happen in the multifamily industry. I do see multifamily still being very strong in COVID and coming out of this COVID, or, when we do, I think we're going to see prices soar and cap rates drop. The reason why is because there's 1.7 trillion of dry powder just sitting there on the sideline. And these large institutions are really realizing what's going on, and they're realizing that that they're going to dump it into the multifamily industry because it's such a very strong asset class and it's risk resistant. And I think they're all seeing that, and I think more and more are going to target multifamily, which is going to be very hard for a syndicator to compete with a fund.
Okay, so let me qualify that a little bit. All right, so when you say they're seeing this as an opportunity, right, you're saying cap rates are going to go down, consequently prices going up as a result of that. And so your comment is that the logic behind that is that you're going to have more demand to purchase in this particular asset class,
correct?
Especially from, in this case, institutional investors. Is that what you're saying? Did I hear that correctly?
You are 100% correct. Yep, they're focused on multifamily and industrial right now.
Okay. And are you seeing that trend take shape in your market now?
Yeah, very much so. We're actually in the process of raising a $350 million real estate opportunistic fund, which is a 506c, and we'll be partnering with large institutions. And with those funds, that is what we're getting with feedback direct from these large institutions, is that they like the multifamily industry. They're allocating more to it because of how strong it's been during COVID.
Okay, cool. So talk a little bit about, you don't have to go into details about, the fund per se, but when you say we're raising a $350 million fund and the intent is to partner with institutional investors, what does that look like, right? Because it's one thing to say, hey, we're going to put a fund together and we're going to partner. I mean, there's one point where I've been in over almost 100 different partnerships, and the structures vary immensely. So what does this look like? When you say we're going to partner, can you elaborate on that a little bit more?
Yeah, so when I say partner, I say that they're going to invest directly as LP investors into the fund. And we're going to go out and seek their multifamily real estate assets and deploy that capital into strategic target markets that we've hand selected. And so that's what I mean by partner, is them investing into the fund as LP investors.
Okay, and so and it sounds like your firm, you're going to be the general partner.
Correct.
And you're going out looking for opportunity to purchase. Now, are they giving you soft commitments at this point, or are they actually funding? Are they funding your fund?
Yeah, you can't fund the fund. The reason why is because if you take all of whatever amount you want to raise, if you take it all up front, day one, your IRR is going to be zero or very minimum, because you're going to now have to deploy that capital, and your IRRs all consist on how fast you can get that capital back to your investors and give them a return. So if you take it all day one, you're going to have really no IRR or very little. So when these large funds, when you see them close $1 billion, $2 billion, $3 billion, they get commitments from these large institutions, and these large institutions sign the PPA. They signed all the commitments, and then from there they go ahead and do capital calls throughout the life of the fund.
Okay, cool. So let me walk our audience through that, okay, just so that they have an idea. Let me kind of break down what you said. So one of the reasons why you get commitments rather than looking to actually inject that capital into the fund is it gives you a better, it allows you to deploy capital a lot more effectively, right? And not disrupt or put more pressure on you to achieve returns with money just sitting around. Money sitting idle, right? Not generating a return it's for sure going to impact how you're projecting the fund to perform, right? So this is just another way to get commitments, or in this case, another way to raise capital with soft commitments, right? To be able to call on that money once you find an opportunity and not disrupt your returns, right?
Yep.
Okay, cool. So, I really like this conversation because it's a conversation around institutional investors, how they're thinking about this particular asset class. And of course, in this case, how you're dialoguing with them, right? So you're getting feedback about why they like this asset class so much. And of course, your projection is that, you're going to see more demand in this asset class. Prices are going to go up, caps are going to come down predominantly because institutional investors, they're going to start placing more capital inside of the space. So very interesting. About maybe 2 months back, Wall Street Journal, there was a big article in there about hedge funds, in this case private equity, the largest raise in the history of the United States. I think it was $69 billion, right? Something like that. It was substantial. It's very substantial. They didn't really get into the asset class, but the funds were really targeting distressed assets. My guess is half of that is going to be going to purchase notes and probably the balance being deployed into, real estate, right? So there is some consistency with what you're saying, right? What that looks like and how that turns out, I guess we're gonna find out. So when you're having these conversations with these institutional investors, what is driving their interest in working with you and your firm? What's the driver there?
Yeah, so when it comes to it, we have a very strategic strategy, and unfortunately, I can't give that strategic strategy away. But that
you don't have to give it away. I'm sure there's one or two things that you can say. Hey, look, the reason why they want to work with us is for X, Y, and Z reason.
Yeah. So the main reason is it gives the whole strategy away. So, I don't want to go too far in depth, but it's a way that we can source deals, we can operate the assets with the relationships that we built in each of the strategic target cities that we have, because we have physical boots on the ground and we've lived in those cities. We have the employees live in those cities currently, and that's a way for us to source deals and to get it and to operate them with third-party property management at a lower cost than if someone from New York would try to find a property manager here, and they may charge them, a little higher management fee than they would us because of our relationships that we built.
Okay, so if I heard you correctly, your value proposition to these institutional firms is work with us because we know our market really well, we have good relationships, and we can help you save money.
Well, that's one of it. Yes, I can't give them all away. I'm sorry, because when you get up to the institutional type of investing, it's extremely competitive. And I even with our pitch deck that we send out, our pitch deck has a special code to it that is just for that one person, and no one else can try to take it. No one else can try to save it because if they save it, it just gets messed up everywhere. And we did that strategically because when you get up to that level, people will try to take your pitch deck, take your information, and it can be very difficult.
Interesting. Okay, so let me ask you a couple more questions. Okay, so institutional investors, you have a plan in place, right? You're at this point starting to execute on your plan. So what type of asset class, what type of assets are you looking for? We already know the class, but what are you looking to acquire product that's already performing? Is it value add? Are you looking to take advantage of distressed assets? Is it ground up construction?
No, yeah. So it's a B value add assets, over 100 plus units, and we will look into A core plus. We do have the option with the fund to invest as JV partners or into brand new development, but our main focus is the B value add assets.
Okay, beautiful. So B value add. Now value add, in my experience, can mean a lot of different things, right? So how are you defining it with your investors?
Yeah, so when it comes to a value add, it's a property that we can acquire where rents are below market, and that all the other competition has nicer type of amenities, nicer type of units, and we're going in there and we're fixing up the units, we're making it nicer, we're making the common areas nicer. We also are adding different little things to the property to enhance the lifestyle for each tenant, and then that's our value add to each asset.
Okay. All right. So your value proposition, right, is essentially you're saying, okay, we're going to go find properties that we feel are undervalued. We're going to make these acquisitions. We're going to bring them up. But the way that you're ultimately defining that is you're looking for assets, okay, that are under market, right, with rents that are essentially under market. So do you feel that that's going to be driven predominantly by assets that are being marginally operated, right? So that are not being, where the operators are not, or in this case, the managers, they're being undermanaged, okay? Is it undermanaged, deferred maintenance? Okay, you already talked about the fact that rents are a little bit below market, okay, or in some cases could be substantially below market. So within that spectrum, where do you feel that what's more commonplace, right? Is the value going to be created from underperforming managers, or is it through improving the asset and attracting a new tenant profile? What are your thoughts on that?
Yeah, so it's really all of the above, and each asset's different in each target market. So it's not just one thing that we're looking at. It's multiple things. Everything that you've explained is really the key to it. And we like to see those, and once we identify those, and it meets our preliminary criteria, and then from there we'll push it to our main criteria, and if it checks all those boxes, then we'll go ahead and pursue it further.
Awesome. And so how are you looking to capitalize these with debt and equity? What is the capital structure that you're considering at this point, and why?
Yeah. So when you're speaking capital structure, are you speaking on top of the capital and the debt that we're providing on each asset?
Just debt and equity. I mean, whatever that.
Yeah, so we're going to look for anywhere around 65 to 75% debt side. The remaining will be equity side, and it all. We're really not big into and especially for the fund, we're not big into the bridge loan or anything like that. We'll go ahead and bring the capital to do all the renovations that are necessary.
Okay, so you guys you're going to be fully funding these projects with debt and equity, so a blend of 60-40, or did you say 65-35?
65 to 75, so in that ballpark.
To 75.
Of debt. Yeah, of debt.
Okay, good. So that's kind of the strategy, right, with your debt and equity blend. Okay, great, man. So now I think we have a pretty good idea, right? So the reason why I'm asking these questions is our audience looks very different on this show, right? We have probably about 10 to 15% of our audience, they're folks looking to get into this space. You have probably a third of that where they're very seasoned operators, right, chiming in, wanting to get some feedback, different ideas, different perspectives, people like you to reach out to because they might be looking to enter into your market or possibly partner with you for that matter. Then the balance of that are limited partners, right, and they run the gamut. So I was speaking with a buddy of mine the other day, very experienced, and this is the only true person that I know that has really made a living investing as a limited partner, right? And he's been over about 60 different partnerships. Very, very savvy when it comes to due diligence and vetting out sponsors. So the reason why I'm asking these questions is to walk our audience through this conversation so that they have some context behind why you're doing what you're doing, right?
Yeah.
Okay, so now we're going to pivot a little bit further. So we essentially talked about the acquisition side of the space. We talked a little bit about how you're capitalizing these assets, right? The third domain of the space is management. And you spoke briefly about management and just your ideas on that, your thoughts on that. You mentioned that, hey, we have great staff in place, great contacts. So talk to me a little bit about your philosophy around managing properties.
Yeah. So when it comes to management properties, it's very important. You can do all the work, but your property manager has to execute the business plan and business strategy that you have for the asset. So it's very important to build very strong relationships with the property management companies in those select target cities that you are focused on when you're acquiring, and making sure the communication and the business strategies in line for those assets, because they're going to ultimately perform and make sure that the business plan performs, so everyone hits their returns and everyone's pleased. So it's very important to interview multiple. We have a full list of multiple lenders, multiple property managers, you name it, and we get bids for everything. Even when we do our syndications, which we still syndicate assets, we get multiple bids, at least minimum 3 per asset, because everyone sees the property differently. Everyone has different questions, and it's good to see it from their point of view as well. So we like to make sure at least minimum 3 property managers put their eyes on it and really gets their head wrapped around it to ensure that we can execute our business strategy that we have for that particular asset.
So what do you think is the greatest value, man, that you bring really as an asset manager, right? You have the property manager, you folks are really managing the asset. I was just got off of a phone call where we were having this discussion around asset managers and property managers, and of course the value that the asset manager is bringing to either assist the property manager in the execution, and sometimes not, right? Yeah. So what value do you feel you bring to that scenario, that relationship?
Yeah, very much so. So when it comes to operating a business, I've been always intrigued on how to operate a business, how to make it successful. And with my previous background history, operating leading the number 1 team in the Carolinas and making them 46% profitable in 1 year compared to their 3 years of being stagnant with no growth, that really comes down to the asset management. So the big thing too is being boots on the ground and understanding the market like the back of your hand really helps for an asset manager who understands the property, but really digging into the P&L, digging into the contracts, making sure that, if you're acquiring an asset, getting bids on everything, rebidding everything to make sure that you're also getting the great quality work being done, but also at the market price. So I think that's extremely important as someone acquires their asset, is that they get multiple bids and they rebid the contracts that are currently in place, and really go through the financials with a fine-tooth comb to see what you can cut, not necessarily cut, but what you can enhance when it comes to marketing to get the property out there and expose the property. A big thing that I'm seeing right now and that we're doing as well is Facebook Marketplace, and really ensuring that we're targeting the right type of crowd for that particular asset on Facebook Marketplace, and that's been a huge growth driver when it comes to that particular asset. And on top of that, you're dealing with the SEO too, which when you're posting about that on SEO, that will also boost you on the Google ranking. So when people are searching for apartments in that area, your apartment complex comes up. So all those little tiny things add up to one big picture, and I think that is really key when it comes to asset manager and asset management of the asset, and also working very closely with the property management company. When we start off with weekly calls until we feel comfortable, then we'll move it to monthly calls. I always still like the monthly calls, at least an hour once a month, after the property's stable and is running very smoothly, to just ensure that you're staying on top of the property management company. Because if you get too comfortable, no matter what you're doing, if you start to get comfortable, you start to get lazy. And I see it more and more with individuals who are entrepreneurs, business owners, you name it. So you want to make sure that the property manager and property management on staff, the maintenance people on staff, are not getting comfortable and getting lazy. You want to make sure you're giving them incentives. You're doing everything possible to make sure that the business strategy is running and operating successfully.
Okay, great. And so, I like what you said. I think, if you stop managing, that's ultimately the result that you're going to get, right?
Oh yeah.
I mean, if you are not managing to a result, your result is not going to be better than that. And so,
correct.
So here are a couple of questions, right? So when you're having this meeting with your managers every single week, in this case monthly, what does that conversation look like? What are the things that you're measuring or that you're expecting of them to be able to hit your performance metrics or your budget?
Yeah, great question. So when it comes to it, one thing, especially during COVID, I'm sure everyone's doing this. We're looking at the delinquency report, collections report very closely to make sure that, we're still hitting our occupancy level that we want to hit, making sure we're hitting our gross income level and our net income level that we still want to hit on a monthly basis so we can provide returns. I think that's extremely important right now. I also like to run over marketing. I'd like to get the statistics on marketing, how many people are reaching out, phone calls, emails, what type of conversations are being had. Normally when they call into the office, those lines are recorded so you can hear how the on-site manager is speaking to people. Are they selling the property? Are they just relaxed? Those are very important. What keywords are they saying when it comes to it? Those are some things. And then, before COVID, and then once this COVID is finished, really making sure when you do monthly events, what type of monthly events, how to keep engaged with the tenants to make sure the tenants feel comfortable and they love the asset. And then also doing that on a virtual level too is very important. So those are just some things on our calls that we go over on a weekly and then monthly basis. We always go over the financials and how the financials are performing, collections and bad debt, any expenses. That's extremely important.
So how do you, now Mike, let's see, I'm going to just take a guess here, so you're going to have to correct me. But it sounds like these are probably 100 to maybe 300 unit.
Yep, there are over 100 unit assets.
Okay, good. That's what I thought, because you spoke about on-site management and institutional investors. So, you mentioned that your property manager is taking these calls, right? And in my experience with these larger assets, if you're really driving leads, it's very difficult for the property manager to not only start selling prospective tenants into the community, but now dealing with all the service related items as well. So how do you create that balance? What does that process look like?
Yeah, so on the call, we normally have the district manager, maybe sometimes the on-site manager is who we really have, not the assistant or the leasing agent or anything like that. And when we have these calls, they're really quick, straight to the point to discuss operations about the whole asset. So it's really not outside of their job title or job duties. It's everything's in line with what they're doing and how to perfect it and how to, if it's talking to a tenant, what are you saying? How can we say it differently? And just getting them to see it from your point of view. And it's just basically coaching them. It's just like a mentor coaching their mentee. And that's what you're doing on these calls when you have those type of conversations. Interesting.
Well, I really appreciate that perspective.
Yeah.
I think, we're coming into a very unique time right now.
We are.
I do believe that for those that are prepared and that are starting to position themselves, they're going to be able to take, really position themselves for opportunity, right? And it sounds like you guys are doing a really good job of that. You're starting to do that now. And it sounds like you've decided to take or to target institutional investors, right, with your plan, which, I think is good. I think is an interesting strategy. Why institutional investors though versus, raising money from, in this case, from private investors? Why the distinction? Why institutional investors versus, private investors?
I think it comes down to our goals and the goals that I have for the company. I'd like to be the next BlackRock, Blackstone, KKR, Carlyle, Apollo Global. And when you do that, you have to go the fund route. And when you go the fund route, it's more capital. For example, there's a very large public pension that by the end of this year, in the next 5 months, they have to deploy $2.4 billion just in real estate alone. Just in real estate, $2.4 billion. So if not, they get penalized.
Their investment policy dictates that they deploy specifically in real estate.
Just 2.4 over the next year. They have to do 4.8. just in real estate, and that's billions. And if not, they get penalized. So it's a different category. It's definitely a different type of relationships, although we will still be syndicating assets, because my goal and the only reason why I got into this business of multifamily is to help people understand that they can invest in these large assets and become financially free by investing in real estate. So we'll still be syndicating assets. I just want to pivot the company into a fund model to get up into the level of a BlackRock, Blackstone, KKR, Apollo Global, and to grow a large company, to supply a lot of jobs, and to help a lot of people become financially free.
Awesome. I really appreciate the feedback. So, Chris, I'm going to ask you to share with us your most successful investment in the multifamily space, and just talk us through, share the story and talk us through, that opportunity and what that looked like.
Yeah, so can't talk exact numbers, unfortunately, but we haven't closed it just yet. But it was an off-market deal that we found. I was touring an asset adjacent to it that was on the market, and I was looking at it, and I asked the broker, "Hey, is that property also for sale?" And he said, "No, it's not. I know the owners, though." I said, "Well, reach out to them, see if they want to sell." And they wanted to sell, so I wanted to combine it, but unfortunately, we lost out in best and final. So about a couple days later, I called the broker back. I said, "Hey, is that property still for sale? Did those buyers acquire this too?" And he said, "No." So I said, "Okay, well, get me in. I want to take a look at the units and love to throw an LOI out." So we did. We were able to acquire it. Throughout due diligence, it had a grease fire. On top of that, we were able to get brand new roofs on the whole complex, free of charge, or we paid $5,000 deductible, but the seller's insurance put on a brand new roof. We actually caught them in a lie, which was helpful to the complex, and then the rents were way below market, and we were able to organically just bring them up $200, $250 just organically, and then that's not even with the value add play, which we'll probably be able to bring them up another 125 to 175, which we're very excited about. So that's a very success multifamily so far, and we're very, very pleased about it.
Okay, cool. So what was the lesson learned there?
Lesson learned there was definitely during due diligence to be very thorough. You cannot, you spend your time during due diligence, make sure you see everything, request all the documents, ensure that you're getting all the leases, and to make sure that you communicate. Communication is key. If you have an issue like a grease fire coming up in due diligence, make sure you communicate to ensure that you get the most money for it, and that the insurance company just doesn't, cut you a small check.
Was it a fire in one unit, or did it spread to other units?
One unit. Yeah, one unit. The fire department got there in time, thankfully, for our first responders that live in Charlotte. They got there very quickly. No one was hurt. The unit was just damaged, and we were able to get it back and rent it.
And so did this happen while you were in escrow?
Due diligence, yeah. It happened like 2 weeks after we signed the PSA.
Interesting. Very interesting. Yeah. And so that fire paid for all your roofs?
No. That fire did not pay for all the roofs. We found issues with the roofs. So we talked to the seller about submitting a claim to their insurance, because we noticed that they did not submit a claim. And when they submitted the claim, the insurance came out, and they had a third party inspect the roofs and come back and say, well, there's no hail damage or no issues. And we said, well, who was the third party? And the third party was a company that wasn't even licensed to inspect roofs, and the roofer who was from the insurance company did not even go on top of the roof to inspect the roof.
That's a problem. Yeah.
So we caught them there very quickly, and he admitted it. And once he admitted it, they apologized, and they went and moved forward with getting the roof replaced.
Awesome. Okay, now a story about the property that was least profitable, right? Or some of the biggest challenges.
Well, we don't have one just yet, knock on wood. I know it will more than likely be coming, as we'll be in this business for quite a while. But I would say challenges in business and in multifamily in general. The challenges that I have is that, really trusting people. I think that's a big thing. Really trusting people too fast, which I need to hold up my guard a little more, because there's people out there, even in the multifamily business, that I've trusted, and they turned out to be really not good people, unfortunately. So it's definitely important to understand that and to build stronger relationships before you trust them.
And so can you give an example of that? I mean, you don't have to go into a detailed story.
No, I will. I placed my capital with someone, another operator, and based off of the documents and based off of what the operator was telling me and the documents that I signed. And then the ball kept rolling, and come to find out there was no asset. Come to find out there was nothing. And I just read an article that another group has filed a complaint, and I'm in the process of filing a complaint with them or with the SEC against them because they just took a lot of people's money. Unfortunately, they took my capital as well, and I'm in the process of trying to get it back. But it was because it was based off of what someone said, and it was all false. So,
was there actually an asset that they were deploying that money into?
There wasn't. Nope. There was no asset. Yeah. Say that again.
Did they present that?
They didn't present a physical asset. They presented it based on a fund level, how they're raising a fund and that they're going to deploy that capital into, or they're going to raise a fund, and then you'll be able to get a certain amount, and if you're involved, and it's a very long process. I'm sure you'll probably hear about it, but yeah, so that's what happened. And I know there's some other groups that actually invested too, and that we never received anything, and it was a long ongoing process. And yeah.
So what was the lesson learned there?
Not to trust someone very quickly. Do more due diligence.
But yeah, so I was about to say that. I
do a lot more due diligence.
Trust someone or do your due diligence. I think there's a distinction there.
Yeah, it's doing more due diligence, but you can do all the due diligence, but you also still have to trust someone, and trust them that they're going to execute. And I learned that I'm not going to, I'm going to make sure I do those due diligence on top of building a stronger relationship before I deploy my capital. So, yeah. But I'm glad it wasn't anyone who was alongside myself, and I'm glad I did not refer that gentleman to someone else.
Yeah, no, I'm
glad it's mine, because I can get it. I can hopefully get it back, and I can swallow that pill. And I'm glad I just didn't refer him to anyone else, because that right there, I could not sleep at night if I did.
Yeah, no doubt. Well, Chris, we are coming to the end of the show. I have one more question for you, then we're gonna wrap this up. So what is the one question that you'd like to ask me that you feel would provide our listeners with a good takeaway, that would provide a key takeaway for our listeners?
One thing that I've noticed is you ask phenomenal questions, and you're extremely knowledgeable. How do you gain your knowledge, and what do you do on a daily basis to keep up with it?
Do you really want to know the answer to that?
Oh, yeah.
Well, my schedule looks like this. I'm usually up at 4:30 in the morning.
I'm up at 5 a.m. I love it.
From usually about 4:45, I start studying for at least an hour a day. And then the rest of that time is actually getting into the market and putting together deals. So the other side of that too is every day I pull a lesson out of everything that I do. Every single day. Whether it's an event, a conversation with you for that matter, right? Is as soon as I'm done with this, and so you see I have a notepad next to me, is I take away the key lessons learned from this conversation. And so normally I'll do that also when I summarize after this as well. But that accelerates my learning. And I think if anyone developed the discipline to do that, it'll change the chemistry in your brain so that you can focus on what matters most. And then the other side of that too is, the other side of that is what I call expensive seminars.
Yes.
real
love the seminars.
Right? Yeah. Not seminars as in the traditional sense of a seminar, but when you're active and you're doing a lot in the marketplace, okay, and I've been in a lot of different partnerships, you just learn various things, right? To your point.
That's right.
You make some mistakes, you learn from them. As long as you learn from them, they can add a lot of value to what you do. I use the word expensive seminar because, you make a couple million, you make a couple mistakes that are worth $1 million. If you don't learn from them, then they were extraordinarily expensive, right? But if you learn from them, you can take that and you can multiply that. So I think any time you run into a challenge and you're able to convert that into an opportunity, it's a massive lesson that will typically pay major dividends down the road.
Very much so.
That's just how I approach this. I think, this business is an amazing business. I've been fortunate to really been able to attract some great partners that I've worked with for now going on 10 years. And they're just great folks. And
I love it.
Really enjoy this business.
I love it. Oh, that was great. Great question,
bud. Well, Chris, share with our audience, how do they get a hold of you? I know there are a lot of folks, me being one of them, that really have an interest in the Charlotte market, or at least understanding the dynamics of that market. And you know that market really well. You have, a very unique connection in that market, especially with your background and just some of the things that you've done as an entrepreneur. And just time and market, right? I think you brought that up, time and market, really important. So how would people get a hold of you if they wanted to reach out and have a conversation with you?
Yeah, you can reach me at chris@qccapitalgroup.com. The best way is just go to our website, www.qccapitalgroup.com, and you'll be able to email me there directly. Fill out a form. You can email me directly. We can set up a call and discuss more about multifamily real estate.
Awesome, buddy. Hey, well, really appreciate you on the show. You've been a tremendous guest.
Thank you.
Really grateful for how you were able to walk our audience through your perspective on working with institutional investors and why, and then also just your comments around the value that we should all create as asset managers and how you do that, especially with the conversations that you have on a weekly and also on a monthly basis.
Yeah.
I found that conversation pretty cool and pretty neat. And then just, your reasons for working with institutional investors and the fact that, you want to scale and be able to use that scale to be able to pour back into your community and provide jobs. I think that's great.
Always.
So I want to wish you continued success.
Thank you.
Excited that you're now a part of the We Build Great Apartment Communities Network.
Excited to be.
Our purpose here is really straightforward. It's clear, and I try to do a good job of that. It's we build great apartment communities to improve how people live, and I think you're turning into an ambassador of that. So I want to wish you continued success, and excited that you're part of our network.
Yes, thank you so much for having me.
You're welcome, bud. And how do people get a hold of you?
My website, www.qccapitalgroup.com. You can go ahead and fill out a form. That will shoot me an email. We can set up a call to discuss more about multifamily.
Awesome, buddy. Thank you so much.
All right. You're welcome. Take care.
Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.